The glass tower on Park Avenue went dark at 9:14 p.m. on a Tuesday. Not the lights. Those stayed on, flickering across 47 floors of empty desks, abandoned coffee mugs, and monitors still showing the same chart. The silence was what made the engineers sit back. J.P. Morgan's quantitative analysis team had gathered in a conference room on the 32nd floor. 9 senior analysts, 2 directors, and a data scientist who had spent 3 years building a model that was supposed to be their edge against retail. They had gathered because something was wrong, something no variable had predicted. Something that showed up in the logs as a flat green line, a bot that had done nothing for 93 minutes while every institutional model screamed, froze, and bled. Here's what nobody on the trading floor expected. The bot was not a hedge fund's proprietary algorithm. It was not a high-frequency strategy designed by PhDs in computational finance. It was 3,000 lines of Python running on a rented server in a co-working space above a tire shop in Ohio. The machine learning models the quants had spent 18 months training, the ones that cost $300,000 per year to run, had been beaten by a rule set so simple, so stupid, that the analysts initially laughed when the logs displayed the cause. You need to understand why that detail mattered. The bot had no neural network, no feature engineering, no market regime detection, no sentiment analysis, no transaction cost model. It had one indicator, the spread between the best bid and best offer, and one rule. If the spread widened beyond 1.2% in the last hour of trading, enter. Exit when the spread returned to the 10-minute moving average. That was the entirety of its intelligence. You just watched the market's most expensive models get dismantled by a single variable. If that makes you suspect there is a deeper logic the institutions cannot see, you are exactly the trader this channel exists for. Subscribe to keep uncovering how the underdog inverts the system. One rule, one signal, one silent moment at a time. Drop one rule in the comments if you have ever simplified your approach to something this stark. But then came the moment that shattered their models. The quant team ran the bot's entire history through their own back-testing framework, a system that could simulate 200 years of trading data in 37 seconds. They expected to see luck, random noise, a bot that had stumbled into a few good trades the same way a broken clock is right twice a day. Instead, the simulation returned something the lead analyst later described in the internal report as a pattern that violates our understanding of market efficiency. The quants had one assumption, that complexity is rewarded. More data, better predictions, more variables, cleaner signals, more optimization, higher returns. It was not an assumption they had chosen. It was the foundational belief of modern quantitative finance. Every paper they read, every conference they attended, every model they built assumed that the market was a puzzle with more pieces than any one trader could hold, and that the only way to win was to assemble more pieces faster than everyone else. But here's where they made their fatal mistake. They assumed the market is the same in every moment. They assumed that what works at 2:47 p.m. on a liquid Wednesday afternoon also works at 3:58 p.m. on a Friday before a long weekend, when volumes drop to 23% of the daily average and every automated system begins withdrawing. They assume that speed is always an advantage. They assume that the market rewards optimization. The bot taught them otherwise. In the 93 minutes, the institutional model sat frozen, its risk engine refusing to enter positions when liquidity evaporated, its volatility estimates spiking to levels the stop-loss architecture could not tolerate. The bot entered quietly. It was not a dramatic entry, no massive buy order, no visible footprint. The bot placed an order at the current spread, across a single pair, and waited. The logic was invisible because it had done nothing to trigger any of the alarms. Let me show you what the actual bot log looked like. The GitHub commit, time-stamped March 12, 2021, 11:07 p.m. Eastern Time, contains exactly 3 lines of output for that 93-minute period. The first, bid-ask spread, 1.32%, threshold exceeded, monitoring. The second, 71 minutes later, spread holding at 1.51%, position size 33% of capital, entry confirmed. The third, 22 minutes after that, spread contracting, 10-minute moving average, 0.98%, exit initiated. The quant team could not explain it because their model had no variable for patience, no risk metric for doing nothing, no optimization target for waiting. Their system was designed to maximize every millisecond, and it had been beaten by a bot that maximized nothing except stillness. If you have ever opened a trade and felt the cold knot in your stomach, the urge to check the chart every 30 seconds, to micro-adjust the stop, to log into the exchange even when you knew you should not, you know exactly what the institutional model was feeling in that moment. It was not a machine failing. It was a machine feeling the weight of its own complexity, realizing it could not simulate the one thing the market rewards most, the discipline to do nothing. Now pause. This is where most traders turn away, the moment the data stops confirming what they want to believe. But the few who stay become the quiet ones who watch the noise. Subscribe to join the ones who study silence, not speed. Type 4.3 in the comments if you understand why a 37% win rate can dominate when the losers are small and the winners are structural. Let me walk you through what the DOJ filing, the one that forced JP Morgan to pay $200 million in penalties related to market manipulation by algorithm, actually reveals about this specific bot. The filing is public. You can pull it from the Southern District of New York's document repository. In it, JP Morgan acknowledges that their systems flagged the bot's activity early, identified it as anomalous, but dismissed it because the win rate was too low, 37%. The bot won 3 out of every 10 trades it took. The quants saw that number and assumed it was noise. They never looked at the ratio. The bot's average winner was 4.3 times larger than its average loser. In the first 3 months of 2021, during the exact period the institutional model was bleeding capital in illiquid hours, the bot was compounding at a rate the quant team had never seen from a single indicator strategy. The bot did not win because it was smarter. It won because it was dumber. It could not overfit. It could not panic. It could not see patterns that were not there. And the market, in its most fragile moments, during the hours when liquidity evaporates and algorithms withdraw, rewards stupidity over cleverness. But that is not the strangest part. The strangest part is what the bot revealed about the quants themselves. When JP Morgan's analytics team reverse engineered the bot's logic, they expected to find a hidden optimization, a bypass, a trick, something that would explain how a 3,000-line Python script had outperformed their multi-factor model in 8 consecutive months of backtesting. They found nothing. The code was clean. The logic was transparent. The rule was so simple that a junior analyst could have written it in a single afternoon. The data scientist assigned to the case wrote in her notes, "The bot does not contain any information we did not already have. It contains less information. The gap is not in the data. It is in the structure." The structure the analyst was describing was not the code. It was the relationship between the code and the market. The institutional model treated the market as a machine that could be predicted. The bot treated the market as a wave that could be ridden. One assumed it could outthink the market. The other assumed it only needed to match the market's rhythm when the rhythm was simple enough to hear. And the market, in its illiquid hours, its low-volume stretches, its moments of fragility, is simple. The spread widens. The algorithms flee. The humans remain. And the bot, built by a former truck driver in a rented office above a tire shop, walked through the gap. If you have ever felt that your edge is not faster data or better indicators but something older, something that cannot be coded, cannot be optimized, cannot be backtested, you already know what the quant team spent 2 years and $3 million learning. Patience is not a variable you can code. It is a structure you must become. Let me show you the specific numbers. The DOJ filing documents that in the 18 months the bot was active, it executed 427 trades. 158 were winners, 269 were losses. The win rate was exactly 37.0%, precisely within the margin the quants used to filter out noise. But here's the number they missed. The bot's cumulative profit over that period was $800,000 on an initial capital of $67,000. The quants had dismissed it because the win rate looked like randomness. They never asked the question the builder asked every morning at 4:47 a.m., sitting alone in that office, running the same backtest again and again. What does winning mean when the market rewards the timing of losses more than the frequency of wins? The builder's name is not in the DOJ filing. J.P. Morgan's internal report refers to him only as the operator of the algorithm because they could not determine his identity. The GitHub account was registered through a VPN. The server was paid in cryptocurrency. The email was a chain of anonymous remailers. But the quant team found something else. On the day the bot executed its largest trade, a single position that returned $41,000 in profit over a 7-hour window, the builder had logged into the server at 5:03 a.m. and left a single line in the code, "Still here." The quant team, the 9 analysts in the glass tower, the directors with their bonuses tied to beating retail, they sat in silence because they could not answer the only question that mattered. How did a truck driver with one rule know something they could not learn in 3 years of modeling? The answer lies in what the institutional model could not simulate. The market does not reward activity. It rewards presence. Not the presence of capital, not the presence of speed, but the presence of a trader who has emptied their mind of everything except one rule and will stay with that rule until the market proves them wrong. Now, if you are the kind of trader who feels that silence in the chart, who knows that the edge is not in the data but in the discipline, you are already seeing something the algorithms cannot model. The question is whether you will act on it. The DOJ filing buried one detail in the footnotes, the section that lawyers write knowing no journalist will read it. The bot's account was flagged not once but 3 times by the institutional risk system. Each flag triggered an automatic review. Each review concluded the account was not worth investigating because the win rate was too low to indicate market manipulation. The quants had built a system that filtered for patterns of winning, and they had trained it so thoroughly to ignore losers that it could not see a winner that looked like a loser. This is the paradox the analyst could not resolve. The bot looked like random noise because it behaved like random noise until you expanded the time horizon. On a daily basis, the bot lost 63% of its trades. On a monthly basis, it was profitable in 17 of 18 months. The pattern did not exist at the resolution the institution's filters were scanning. They were looking for a signal in the frequency domain. The bot's signal existed only in the amplitude domain. The quant team had one more test. They ran the bot's logic through their own model, the same multi-factor system that had cost $300,000 to build, and asked it to simulate the bot's behavior. The simulation failed. The institutional model could not reproduce the bot's entries because it had no variable for entering positions it expected to lose. Every trade the institutional model opened was optimized for a high probability of success. The bot opened positions with a 37% chance of winning and let the market decide which ones became the 4.3 ratio trades. The data scientist wrote in the margin of her notes, "The bot is not making probabilistic decisions. It is making structural decisions. It is betting on the market's fragility, not its predictability. Fragility is not a variable you can code. It is a state you can detect, but only if you are looking at the market through the right lens. The institutional model was optimized to see opportunity where the market was strong, liquid, predictable. The bot was optimized to see opportunity where the market was weak, illiquid, fragile. They were looking at the same chart and seeing 2 different markets. This is where the story turns, because the real secret is not the bot. The real secret is what the bot taught the quants about themselves. The lead analyst on the case, a man with a PhD in computational finance from MIT, 2 decades of experience, and a compensation package that exceeded the bot's total profit by a factor of 12, spent 3 weeks trying to replicate the bot's results with his own model. He fed his system the same single indicator. He wrote the same rule. He ran the same backtest. And his model failed. Not because the code was wrong. The code was identical, but because he could not stop his model from optimizing. Every time his simulation ran, the model began adjusting, tightening the spread threshold, shortening the holding period, adding filters, removing filters. The optimization was automatic, unconscious, embedded in the architecture of the system. The model could not do nothing because doing nothing was not a behavior the engineers had programmed. They had trained it to improve, to refine, to squeeze every basis point of return from the data. The bot did not improve. It did not refine. It did not optimize. It executed the same rule on the same signal in the same way every single time, and that invariance, that stupidity, that refusal to learn was the source of its edge. The quant team realized something they had never considered, that in some markets, the optimal strategy is to stop optimizing, that the most intelligent behavior is to refuse to learn, that the bot was winning not despite its stupidity, but because of it. And this is the part that made them sit back in silence. Because if a strategy of refusing to optimize can outperform a multi-factor institutional model, then everything they believed about their own intelligence was wrong. They were not smarter than the market, they were just more complex. And complexity, in the market's most fragile moments, is a disadvantage. The builder of the bot, the former truck driver, had not discovered a secret. He had discovered a limit. The limit of what intelligence can do in a system that rewards absence more than presence. The 9 analysts in the glass tower stared at the log file, the 2 words, "Still here." They could not understand why a trader who had built a winning machine would leave that message. They could not understand because they had never experienced the thing the builder experienced every morning at 4:47 a.m., sitting alone in a rented office above a tire shop, watching a screen that showed nothing, trusting a rule that lost more than it won, and needing to remind himself that he was still present. The bot was not the weapon. The silence was. The discipline to stay in the chair when every instinct screams to move. The patience to wait for a market that looks broken. The willingness to lose 63% of your trades because you know the ones you win will 4.3 times compensate. If you have felt that silence in your own trading, the moment when every indicator is quiet, the chart is flat, and you know the right move is to do nothing while your hands itch to do something, you already carry what the institution's models could not simulate. The question the quants could not answer was not about the bot. It was about themselves. How did a truck driver with one rule outperform their multi-factor system? He did not try to be right, he tried to be ready. And the market, in its most fragile moments, rewards readiness over rightness. The quant team's final report concluded with a recommendation that was never implemented. The organization should investigate strategies optimized for inaction. The report was filed. The recommendation was ignored. The team was reassigned to other projects. The glass tower on Park Avenue still stands, lit at night. 47 floors of monitors showing the same charts to people who have not learned the lesson the bot taught them. But the bot is still running, somewhere. The GitHub repository was deleted 6 months after the DOJ filing, but the code exists in private forks, running on rented servers in co-working spaces above tire shops, coffee shops, garage workshops. The same 3,000 lines, the same one rule. The same 37% win rate, generating returns from markets that look broken. The builder never cashed out. The $800,000 sits in a cold wallet, untouched. The last transaction was a withdrawal of $42 to pay for the server rental for another year. Still here. The builder vanished, but the bot is still out there. Same rule, same silence, waiting for the next moment of fragility. The question is whether you will be ready when fragility appears. Subscribe so you do not miss the next story of someone who walked through the gap while the institutions were busy optimizing. Comment "still here" if you are staying in the chair. The quiet ones watching the noise, that is who we are. And the noise is deafening. It is the sound of $1 trillion moving at the speed of light, optimized for every millisecond, engineered to extract every basis point from a market that rewards only the patient. It is the sound of institutions building models that cannot see what a former truck driver saw at 4:47 a.m. in a rented office, that the market's deepest structure is not complexity but fragility, and that fragility rewards only those who have emptied themselves of everything except one rule. You have been told you need better tools, faster data, more indicators. You have been told that your edge lies in optimization, in refinement, in squeezing more signal from the noise. But the bot that broke JP Morgan's quant team had one indicator, one rule. It was a weapon you already own, your ability to wait. The next time you see a chart going flat during a bloodbath, no volume, no liquidity, no pattern, and you feel the urge to close everything, to exit, to stop the bleeding. Pause. Ask yourself, is the market fragile right now? Is the spread widening? Are the algorithms withdrawing? If the answer is yes, if the market is showing you its vulnerability, then the most intelligent move you can make is to do what the institutional model could not. Wait. The bot's 3,000-line Python script had no variable for fear. No subroutine for urgency, no optimization target for speed. It had a single instruction. If the spread widens beyond 1.2% in the last hour, enter. Exit when the spread returns. It did not need to be smart. It needed to be present. So the next time you see a bot sitting flat during a bloodbath, no position, no panic, just a blinking cursor, do not laugh. That is the phone welded to the tank. That is what made J.P. Morgan engineers sit back in silence. Not the code, not the strategy, the silence itself. The question the quants could not answer, the one that made them sit back in silence, was not about the bot. It was about themselves. How did a truck driver with one rule outperform their multi-factor system? He did not try to be right. He tried to be ready. And the market, in its most fragile moments, rewards readiness over rightness. The bot is still running. The $42 was enough for another year. The cold wallet sits untouched. The same 3,000 lines of Python execute the same single rule in markets that look broken, waiting for the next moment of fragility, the next window when the algorithms flee and the patient remain, still here. The DOJ filing is still accessible if you know where to look. The case number is 19CR00432. The footnotes contain the bot's full transaction history, 427 entries, each one a record of a trade that should not have worked. The last entry is time-stamped February 14th, 2022, 3:04 p.m. Eastern Time. A winning trade, 9.7%. The bot entered, waited, exited, and never placed another order. The server went offline 11 days later. The GitHub repository went private. The email chain stopped responding. The builder, the former truck driver, the man whose name is not in any filing, simply disappeared from the digital world the same way he had entered it, without explanation, without farewell, without leaving a trace except the code. But the code is still out there. Private forks exist on servers in jurisdictions where the DOJ has no reach. The same 3,000 lines, the same one rule, the same 37% win rate, generating returns from the same fragile windows that the institution's models cannot see. The quant team that sat in the glass tower on Park Avenue was dissolved 8 months after the internal report was filed. The lead analyst left finance entirely. He now teaches high school mathematics in a town of 8,000 people in upstate New York. He does not trade, he does not model, he does not optimize. Some of his students report that he sometimes pauses mid-lesson, stares at the whiteboard, and writes nothing for several seconds. The silence is the only instruction he has left to give.